taking all those things into consideration, we decided the acquisition was good for us because it was both cash and equity in the parent company. We got a percentage from the top line revenue. We maintain an autonomous company. What happened in the acquisition was that I continued to manage the company. We had full autonomy. We just, at the end of the month, would send an email to our parent company saying, all right, this month we need this and this amount of money, and they just transfer it. So it was a really easy life.
Hello and welcome to episode number 11 of Tech Careers and Money Talk. I'm your host, Christopher Nelson. I've been in the tech industry for 20 plus years, and after climbing my way to the C-suite, working for 3 companies that have been through an IPO, and investing my way to financial independence, I'm here to share everything that I've learned with you and introduce you to others that can help you along the way. Now, today, we are talking with Litan Yahav. Litan Yahav is a serial founder who built and sold a company for a great equity payday and now also spends a lot of his time as an alternative investor. I want to make sure and dig into this interview. What are the things that helped him grow his career, that helped him get this company to an exit? And then how is he taking the responsibility to being his own wealth manager today? I want to ask him a lot of very detailed questions and really end this with then how is he building tools for other people today in tech to be able to manage their money as well. I'm excited. Let's get into this. All right. I'm excited to introduce everybody to Litan Yahav. Litan is a serial founder. He founded Sagoma in 2012. It's a 3D imaging company around diamonds. He ended up getting it acquired by R2Net, which is a fascinating story, and then went on to found Vyzer. Vyzer is a investment management platform for individuals that can manage your traditional investments along with your alternatives. And this is so important to many of us who invest in alternative investments. I'm excited to dig into his story today. Welcome, Litan.
Thanks, Chris. Excited to be here.
Well, great. Well, like everybody else on the show, I love starting with origin stories. And yours is so interesting because you had this career as a naval officer. Then you were, doing a lot of sailing, and then boom, all of a sudden you're a startup founder. That's how it reads on LinkedIn. But I would love to hear a little bit more of, how did you discover technology and decide to go found a company?
Yeah, sure. Yeah, the background is important. So first of all, I live in Israel, but I was born in the States. In Los Angeles. And when I was 9, my parents took me and my brother on a trip around the world because a good friend of them passed away and packed us up to homeschool us. And our first stop was Israel.
Wow.
And my mom told my dad, you can go wherever you want to raise my kids here. My mom's American, by the way. My dad's Israeli.
Wow.
And she wanted to move us here. And so we've been here ever since. I went to school in Tel Aviv, then got drafted into the Navy. For those who don't know, in Israel, military service is mandatory. So everyone after high school gets drafted. Men used to go in for 3 years, women for 2. Now they do a little less. I got drafted into the Naval Academy and was in the Navy for 6 years as a naval officer on warships, and sort of always had this entrepreneurial spirit, I guess, even before the Navy. It's like I was, trying to teach myself to code a little HTML, stuff like that, trying to build websites. And during the Navy, I always think outside the box. And so I've always had this sort of pull towards, building stuff and solving problems. So after the military, 6 years in the Navy, every Israeli finishes the military, goes traveling. So I went traveling for like 6-7 months in South Central America, got back and went to school, studied law and business. And during that, worked as a sailing instructor because, sailing, Navy makes sense. And totally. And during school, my then girlfriend, now wife, and her sister, we founded a tutoring school. We had teachers that came work for us, and we had kids come and pay us to learn and get tutored. And that was my first real experience of entrepreneurship, like actual entrepreneurship. We didn't raise money, but it was like we all pitched in some money, and dealing with hiring people and renting a space and firing people, which just like anecdotal. It was like, for me, being in those positions where you're out of your comfort zone. Like we had to fire one of the employees and was like, I want to do it because I want to experience it. It's a shitty situation, but I want to experience it. So when I do it in the future, I'll actually grow and do it better. So anyway, so that was the first experience as an entrepreneur. And then we can dive into the rest of it. But that's sort of like went to school, and during school, met amazing people and was part of the Sam Zell entrepreneurship program at the end of school. And during that,
Yeah, I
founded the
read
previous company.
an article that you wrote recently on that. So what was the impact? Because sometimes I do think that specific programs can have deeper impacts on people. What did that Sam Zell program for entrepreneurship? What was the impact that it had on you?
So first of all, Sam Zell, who recently passed,
That's right.
I think a month ago, the dean of this Israeli college approached him, Sam Zell, like 25 years ago. And like every billionaire, he came and asked him, well, can you donate money to the school and we'll build a building and put your name on it? And Sam, and this says a lot about the person, is like, I don't want a building on my name. I want to do something that's more profound, that's more contributional. And so he said, how about we build a program which helps, I don't know, high achievers
Yeah.
build something big, either in leadership positions or entrepreneurial stuff. And he did the same type of program as he did in Israel and two other colleges in the US as well. So there are three programs that are funded by Sam Zell that are built to sort of as a launch pad for entrepreneurship. And so this program was basically, I heard about it before even going to school, and I heard that this specific school had that program, and it's the last year of studies from all faculties at this college. 20 people get into this year-long program of founding a business,
Yes.
looking for an idea to build, team formation, validation, ideation, all the Asian words, and
Yeah.
and the sky's the limit. And so that was super powerful also because meeting amazing people, um, learning really important stuff, uh, and also a lot of push and drive to actually doing the legwork. And
Right.
so it was an amazing experience. And I can dive into that like just for a whole area, but
Yeah,
how we're
we
about the
could,
program.
we could, no, I wanted to touch on that because I think many people, right, especially getting into startups, there are multiple programs around, and I think what you highlighted there, and the things that I'm hearing in common around those programs are they give you the skills, but they focus on execution. Okay, how do you fail fast? They do things that may be a little different than what you learned in normal school. Well, okay, you don't want to fail your exams fast, right? But arguably in entrepreneurship, you want to fail fast, learn, iterate. And then, so did that give you the momentum when you came out of school that then you started focusing on Sagoma and looking for those opportunities?
And so this happened within the program. So at the beginning of the program, it's
Wow.
like 20 people. First week is all right. You have to form teams of 2 to 4 people, and then within like 2 months, you have to have an idea
Okay.
that you want to execute. And so you start just like researching the world and finding where are there opportunities, where are there problems to solve, inefficiencies. And we found the diamond industry to be a very inefficient, old-fashioned industry.
Fascinating.
And yeah, and so essentially we started the whole ideation phase and validation phase within the Zell program.
Hmm.
And at the end of the year, it's a year-long program. They fly us out to the U.S. to meet with a bunch of interesting people and VCs. Like we had lunch and dinner with Warren Buffett. It's an
Wow.
amazing experience. And at the end of the year, it's like hopefully most people continue with the business ideas or
Hmm.
actual businesses they founded throughout the year. And so at the end of that year, we were 4 guys working on this thing together. 2 of us decided we wanted to continue building it. 2 other guys decided they wanted to do other stuff, and that's fine. We're still really good friends. And so me and my co-founder, after school ended, we're like, all right, what do we do now? And how do we take this thing off the ground? And we just went all in and just continued meeting with people. And that's also a whole story we can dive into. But that's sort of like the whole program itself was the facilitation for the diamond business,
Hmm.
but the actual work of building it happened after we finished, when we just went all in on it.
Right. And so at that point in time when you were thinking, did any of the, ideas around startup companies and, now you're a founder, equity owner, building wealth, was that a part of the mindset, or was that something that just sort of came along with your entrepreneurial spirit to go solve problems?
So I guess my answer is that I've always had the spirit of trying to solve problems with technology.
Mm.
And I think what these types of programs help do is focus,
Mm.
understand, like you said, like focusing on what needs to be done,
Right.
on on iterating fast, not building a product until you feel like this is what the product needs to be that needs you
Mm.
need to build. Like a lot of people go ahead and go and build out and write a bunch of lines of code,
Right.
and then they go and look at and then they go and look for if there's a market for this, right? But
Mm.
you learn, right? You learn the right way of doing things. Like, all right, let's first validate the market. Let's do the minimum viable product before writing any kind of line of code to make sure that this is something that people would actually buy. So I
Mm.
think those are things that are perfected in this type of I won't call it an incubator, but this type of entrepreneurship program.
And so tell me a little bit about the size and scale of what you grew Sagoma to be.
Yeah. So before even I'll dive into that, but just to put things into context. All right. So when we started Segoma, which is the 3D image diamond thing, we interviewed a lot of people within the diamond industry, and everyone in the industry said this is something no one will use. All right. Just to put that into context, because it's a very old fashioned industry where people are used to trading diamonds very old fashioned, flying around the world with diamonds. Man, you're like it's like crazy way that like we always tell the story about these diamond exchange buildings with the highest level of security you can imagine. But once you enter them, you go like 50 years back in time. So old fashioned, like long hallways with doors with handwritten notes saying, I'm looking to buy, I'm looking to sell these and these types of diamonds. And then brokers walking down these hallways with suitcases full of diamonds, knocking on doors and going in and out. And people flying around the world with diamonds and suitcases. It's just like crazy. And we said, like, that doesn't make any sense. Why can't you know, take a diamond, photograph it very high with very high resolution, high precision tech, and send an image of the diamond to someone who wants to buy it on the other side of the world? And presenting this solution to an old fashioned diamond dealer, he's like, no, I want to smell the diamond. I want to see the light. And we're like, shit, how do you convey that, what he just said, into an actual technology? And, but on the other hand, you have these kids of these diamond dealers who were born with iPhones in their hands and always looking for tech. And so we really have this deep belief that if we deliver, then people will use it. And and we ended up building this type of microwave machine where you put a diamond in, it photographs it from hundreds of different angles and creates a 3D image, which you can then just send a link to. And someone on the other side of the world can look at that interactive image and buy the diamond or ask to send a diamond for inspection or even buy it based on that image. And that ended, and our belief was that this would be a very big play for the B2B trade. So traders around the world would trade diamonds. We never really believed that any consumer would buy a diamond based on our images because you'd see everything. Like you'd see a diamond all over your screen with all the imperfections within it. And we're like, well, no consumer is going to buy a diamond based on this. And so, I mean, I'm saying that is because our one of our initial investors was this online e-commerce platform for selling diamond engagement rings, and they wanted to use this tech on their website. And the negotiation about how would they do that, and what type of exclusivity they receive was really under the belief that we said, well, no one's going to really, but if they want it, fine. But our business is going to be a B2B business. Anyway, long story short, it grew to be the main business. And we ended up establishing diamond laboratories, like photography laboratories, in all the diamond exchanges in the world, which are basically five main locations in the world. And what happened was we'd have these machines in our offices in Israel and India and Hong Kong and Belgium and the US. And diamond dealers would bring us their diamonds. We'd photograph them, put them on our website. Those diamond dealers would then send a link to those images to their buyers in the whatever in the world. And based on the image, they'd they'd buy or not. And so it became a standard. Fast forward, the same company that invested us bought us, and turned out to be the situation where we'd photograph every single diamond almost in the world. So when we left in 2018, after 3 years of earnout, we were doing 7,000 diamonds a day.
Wow.
So basically photographing almost every diamond in the world. And today there is almost no diamond in the world that doesn't go through our tech.
That's
and
amazing.
So that's the law.
Wow.
Yeah.
In how many employees did you have at the end?
250.
Okay. No, so that's not, I mean, talk about a scalable company with tech, 250 employees, photographing, all the diamonds in the world. I mean, that's got to be some nice, efficiency that you're getting from the product.
So yeah, but so most of the diamonds are actually manufactured and polished and photographed in India. Not many people know this, but like I'd say 95% of our business was in India. And we had an operation in Hong Kong and in Belgium and in New York and in Israel as well. And now there's also in Botswana and places all over the US, but essentially most of the work is in India. And so we had employees working there 24/7 with a whole
just photographing.
end-to-end, just photographing that. It's not just photographing. Imagine someone bringing you a diamond, ensuring that there's a diamond in the small packet, and then there's a whole manufacturing.
No, I know it's a chain of custody. My understanding, it's a chain of custody. You're essentially, you are creating a complete validation of what that product is. And you're right, photograph is obviously too light. That's something we can comprehend, but my understanding is you're validating it from end to end, and that it's probably now part of a security cycle now too, of, okay, now we have this evidence of what everything is to go from place to place.
Yeah.
So
anyway, so that's sort of the story, the Sagoma story.
Well, but part of the Sagoma story too, I mean, I think from a career perspective, as you went from a co-founder to a CEO, you're negotiating then an acquisition. I mean, that was something I'm sure you didn't get a chance to learn in the Sam Zell program. I mean, you had to figure some of that stuff out. And that's something that, I think in this, concept of tech careers and money, like I'd love to hear a little bit about how did you evolve to become the CEO? And then how did you, start thinking and planning for that exit and know it was the right time?
So we founded the company, and we decided that I was going to be the CEO. My co-founder was going to be COO, and we convinced a tech guy to join us, full-time co-founder, quit his job and join us. And so that was sort of the origin of the CEO aspect of it, which wasn't something methodological. It's like, that's how it turned out.
Right. Almost like drawing.
And it worked. Well, it worked well. I mean, I'm also, I'm American. I'm English. I'm more sort of external. My other co-founder is more internal. And so it worked really well. And then fundraising was a process throughout, establishing a company, maintaining a company. At some point, our investor was, again, the same company that invested, was also the one that acquired us. So it's not the conventional play of VC startup world, but it was an interesting play out because we raised money, and then like 2.5, 3 years in, we got approached by our investors saying, listen, we want to acquire the whole company. And we're like, well, we need to think about it. And so the whole negotiation part here was interesting. And also, we need to go through another round of financing. And so we met with other investors to see about raising money, and at the same time had this acquisition on the table. And there's always a question if this acquisition is at the right time, and if we can create or capture more value maintaining as we are. And if post-acquisition, it'll be fun for us to continue to operate the company. And so after taking all those things into consideration, we decided the acquisition was good for us because it was both cash and equity in the parent company. And we got a percentage from the top line revenue. And we maintain a sort of an autonomous company. So what happened in the acquisition was that I continued to manage the company. We had full autonomy. We just at the end of the month would send an email to our parent company, say, all right, this month we need this and this amount of money, and they just transfer it. So it was a really easy life. Like that, the and we also thought that this was like a synergy because if we become the same company, we have a chance of becoming something a lot bigger than if we were each of us on our own. And it worked out well because a few years down the road, our parent company was acquired by a huge public company, and so it turned out really nice. And the funniest thing is that the parent company was raising around the financing, and the investor that was going to invest defined an ultimatum that they'll only invest in the parent company if they acquire us. And we only obviously learned that after the fact. And
Wow.
maybe if we knew that, it could have gave us more leverage. But I mean, it was a good deal. I can't complain.
Right. Now, I think that's always interesting. It sounds like there was a lot of levers there that turned that into a big win-win. You got cash, so you had the ability to say, let's de-risk this. We have, all of our investment of time, sweat equity in there. Now we can take some of that off the table. You get shares then in this new parent company, so you're incented to continue to drive. And it sounds like there was also a top line revenue split. So then as managers, let's keep growing the company. Yes, we want to make sure all the diamonds in the world are imaged by this particular piece of technology. And then go ahead.
And also, it was sort of like golden handcuffs because we also really got really nice salaries and it was really easy and comfortable and like so. Yeah,
it is.
I mean,
and so for many of us that work in technology and we have these exits, whether it's IPO, acquisition on whatever level it may be, when all of a sudden we go overnight from, okay, there's this theoretical value to these shares to all of a sudden now I'm getting this big transfer in the bank. What was that like for you?
it was exciting. It was overwhelming. But it was a really good feeling. Like we started this thing that was a total idea, a long shot that everyone told us that the chances of us succeeding are close to zero, and then there's a windfall event, and that's just a really good feeling. It gives you also a boost of confidence as an entrepreneur.
Right. It gives you a boost of confidence that and I think talking to other people that I know that are serial founders that grow companies to acquisition, once you understand that motion, once you understand what all of that, looks like from a numbers perspective, from a product fit perspective, know what it feels like to actually go through that, then all of a sudden that process becomes a little bit easier.
It's still really hard, but I think you put things into perspective, right? That's the thing.
Yeah. I mean, and maybe that was the wrong word. It's not that it gets easier, but what, it's almost that sense of flow or the sensation where when you're on the right track, like you're able to, with this innate sense of being able to understand how you're navigating the company because you understand what feels right. But you're right, the fuel to all of that, the fuel to growing any startup company is a lot of hard work. I mean, and it can be excruciating from a lot of different perspectives. Don't want to skirt that.
No, I mean, and thinking about like when you build a company when you're single versus building a company when you have a wife and 3 kids.
Oh
Dude,
yeah,
it's like wow, it was so easy.
oh yeah. I know when you're single and you can throw all your hours at your career and burn the midnight oil, it's great. And then when you try and do that and you're getting woken up at 2 a.m. because your wife's like, you got to go take care of that kid. That's brutal. There's no doubt about that. Well, I think we're at this the halfway point really of the episode. So I want to take a quick break, and I want to come back and I want to start talking about post acquisition, how you really then took a break and started focusing on alternative investments. So we'll be right back. Okay, and we are back with Litan Yahav, and we left off where your company gotten acquired, you'd gotten a nice payday, you've done the earnout. Now you're on break. Now all of a sudden you have a lot of wealth that you need to manage. What were some of the first steps that you took to start saying, okay, how do I actually start leveraging this to work for me?
So first off, get approached, with the PR around an acquisition, you get approached by a bunch of people offering to manage your money, offering to sell you a financial product, this means or another. And it is a little bit overwhelming. And, us being entrepreneurs, also liking risk, we're like, well, we can do part of this on our own. We're good. And we also know enough people that have done similar situations, that have been in some similar situations. And so it's like, all right, so we didn't make tens of millions in this exit, but we made
Right.
enough.
Yeah.
And we wanted to continue to grow it, right? And so when you want to continue to grow it, you want to take more risks than just put it in an ETF or just put it in some sort of stock bond allocation. And for us, and we live in Israel. And the thing about Israel is that every second person here does real estate private equity investing.
Oh, wow.
The joke is that if you have $50,000 free cash, you're going to go buy an apartment in Berlin you've never seen before. That's like,
Wow.
because you know a guy who knows a guy who does it.
Right.
And so you start meeting with people that either sold companies or are in that world of
Mm.
private investing. And during the time, the cash had to sit somewhere, and we got approached by different private banks, and we ended up putting money in one of these private banks here in Israel. And the funny story is, 3 months later, they kick us out of the bank because we took all of our money and we invested it elsewhere because we didn't
Ah,
want to invest it into the products. We just deployed capital mainly abroad in the U.S. and in Europe, with people that we grew to know and trust, and decided that was the route for us. And there were different things we did in the private alternative investing world that we liked more, other than we liked less. Learned a lot about leverage,
mm.
which now is a bad word, but back then it was a good
Right.
word.
It was a great word. Yeah. When it was low cost of leverage. Yeah. So that you brought up a really interesting point. So there's more, it sounds like there's more of a culture of looking at private equity versus there is in traditional. And so for everyone here listening, here in the United States and abroad too, but traditional investments here in the United States are our stock market, the bonds, certificates of deposit, CDs, any money market account. Those are things that are going to be overseen by the SEC, the Security and Exchange Commission. There's a series of rules. They're very liquid, productized. Anything outside of that is considered alternative investment. And the main one that many people know is real estate. We all love real estate. The reason is that in real estate here in the United States anyway, I'm not sure what the tax treatment is overseas, but you basically get paid four ways, right? As you get the cash flow off the property, you actually get depreciation, so that helps you on your taxes. You can get appreciation, the property can increase in value. And then also, depending on how the debt structure, you can also be getting equity pay down. So you're actually, somebody else's is paying into the equity that you're getting to own more of. And so from your vantage point, you saw, okay, let's start then taking more risk, deploying things into private equity. How did you start learning? What was your path to learn to underwrite or to vet operators?
Really simple at the beginning. It was basically, will this person screw me over or won't they? And and the best way for me to vet that was how, like, the level of trust that I have with this person. So they're either a really good friend of mine or a really good friend of a really good friend. That was like the
Mm,
first off the bat path to decision making for us. And again, because we're in Israel, it's pretty easy to find those people that you can trust.
mm,
The risk for their experience might be a different type of risk, but we ended up doing that. And so, like, the first two investments we did were actually buying two single family homes in Ohio.
okay.
And these were two single
Yeah.
family homes in Ohio, and the idea was to rent them out and have a property manager. We did not see these properties. We never visited them. Like, I didn't really care about pictures or anything. All I wanted to know is that this is a person I trust. The numbers make sense, and we bought those two properties. And at the same time, we also invested in a few syndications. So
Okay.
those syndications, and we can dive into that, but that's the private equity real estate where you just put in cash and it's totally passive.
Right.
Um, and these single family homes, they were, I don't know, it was a shit show, and you can bleep that out if you want, but it was a
Yeah.
shit show. And so, um, they were just like a lot of work, not generating the returns we were expecting. And at the same time, these syndications were like, we'd get, like clockwork. Every quarter we'd get distributions. They were overperforming. They were about, like, it was outperforming the single family homes. And we're like, why would you want to do this? We work so hard on phone calls with, property managers and tenants in the municipality. it's not performing as we expected. Taxes are hard. Let's just put more money into syndications as opposed to this stuff, and that just continued to grow. And we only managed to get rid of these single family homes like 2 years ago.
Wow. Yeah, and so I think what Litan is drawing out here is that this is the active versus passive investing. Active investing is where you directly own an asset and you have to then bring in the team, the managers, whatever. And remote active investing is really hard. And even active investing in your backyard can be hard because the question is how many phone calls are between you and the broken toilet? Honestly, right? It's like that versus, the real private equity, the real passive investing is then investing in syndications where everybody pools their money together to buy a single asset, or there's also very efficient private equity funds, and you get the same benefit. You get those same four benefits that I articulated before as an owner, but you are a limited partner. Your liability is only limited to the dollars that you put into that deal itself. Go ahead.
I have this sort of, for me, I look at the investing strategy for me as there's passive and active. That's like one sort of line of the side of the chart, and then there's risk and return, right? So
yeah,
and there you can it's always a matter of like how much you want to be passive versus how much risk return you're looking for, right? And for me, I want to be as passive as possible, but with high risk return. And so for me, that was like, where can I be as passive as possible with high risk return? Private equity real estate investing for me was a solution. There's even more passive, like with lower risk return.
Oh yeah,
which is like like publicly traded REITs, for example. And there's more active with higher risk return, which is active real estate, like the extreme being Airbnbs, for example.
right.
And so we put ourselves on the spectrum of I want to be passive with relatively high risk return, and that was the asset class for us.
And then so as you started then maturing as an alternative investor, what other, so your first active investments were single family homes. What were your first syndications? Multifamily?
Yeah, multifamily value add syndications. I think the first one was in, I don't remember, somewhere in Florida. The second was in Atlanta. And these like, simple multifamily value add plays.
Mm-hmm. And where did you then diversify your portfolio from there, whether that's geographically or different asset classes?
It was always about the operator for me, the GP, right? How do we find more people we can trust who have other deals? It didn't really matter the deals, just the numbers we needed to match. And then it turned out being that we invested in developing deals in the US, some in Europe as well, because we wanted to diversify from a currency perspective. We wanted US dollars and euros. And so there was more multifamily, more development stuff, development of building flips or land development or apartment flips. So it was a lot of those types of deals with different operators, just finding the people we can continue to trust that delivered well. And then within those operators, there are people that we also learned a lot about, like what even the definition of these syndicators is. Like there's a capital raiser, there's an operator, there's a syndicator. And then there's the vertically integrated syndicators. There's so much terminology within the world of private investing that it took us time to sort of learn the ropes and get more familiar with all the terminology and stuff like that.
It is, and and this is where, I think sort of now sort of coming back out, right? I think as when you go through these exits, you get this wealth, and all of a sudden now I'm a high net worth individual. I want to now have a portfolio that's in traditional investments, but I want to start playing in alternatives. I think I heard you say the same thing where I want my traditional portfolio to be on automatic. I don't want to have to manage that because I want to spend the time managing my alternative investments, because for me, that's where the cash flow is. That's where the greater reward is. That's where the greater tax benefits are. I want to spend my time there. And I think that's what I heard you say as well, is that's where you're seeing the real opportunity is, from a understanding and knowing your portfolio. And the reason I think many people don't do it, at least here in the United States, they either don't know about it or it's challenging. Like it takes some work to get into.
The biggest challenge, and I just want to clarify, it's not the time. I don't want to put more time in. I want to put more cash in. And when it becomes too much time, that's why we built the current company. But I think that the biggest hurdle that people find in private investing in general is finding people they can trust. That's the biggest challenge, right? People are like, well, how do I find a good operator? Well, what if they're lying? What if they screw me over? That's the biggest problem that people face.
I think you're right. I mean, because the thing is when in any relationship, you have to put in time. I mean, I know, I'm going through a vetting right now, and I've been watching this particular team operate for probably 14 months, watching them, getting their reports, jump on the phone, ask them what they're doing, because, I'm going in cold to this group. They came and they gave me the sales pitch, looked great. But if they're willing to answer my questions, take time, we get some meetings, and I'm watching how they operate, how transparent they are, those things, like, that's what it takes sometimes, especially if you're thinking about deploying, hundreds of thousands of dollars of my own money and maybe even other people's money too. Those things take time, and you got to be patient.
Totally. It's like, so that's what people like I've seen recently have been growing into connecting with similar people, similar individuals, communities, like investor communities, these forums, groups, connecting with people that have that experience, that have done it before.
Yeah. Well, and that's actually, I think a great thing too, is that there are a lot of groups, there's a lot of like-minded individuals that then it goes back to that, chain of trust that you were talking about earlier. As I get to know, an investor, and we start sharing, results, and not that we always talk dollar amounts, but we'll talk about what was our cash on cash, what was our IRR, and what was the relationship with the different operators. Then we're going to start then investing as a pack, investing as a team, because I'm definitely going to follow that chain of trust as far as I can.
Because reputation is everything, right? And people will not ruin their reputation within these groups.
It's true. It's very, very true. So now, as you're growing as this alternative investor, all of a sudden you realize that managing this stuff on a bunch, like 100 different spreadsheets, is brutal, and you see another opportunity. Walk us through how did your passion for investing, and then to your point, not wanting to take a ton of time of it, lead to the second company.
So like I mentioned, for me, it was like passive. Remember, passive versus risk return.
Yeah.
And at some point, a few years in, we did like 20 something deals, and I get an email, and I'm like, oh shit, when did I invest with this guy, and how much did I invest? These are good problems to have, but like, it just became a mess. It became a whole job of managing the interactions, managing the cash flow, the tax documents. Just became hard for us, and like we didn't make enough money to have a family office or stuff like that.
Right.
And so you're like in between building a crazy spreadsheet, working hard to update, tracking down cash flows, tracking down documents, and we're like, well, there has to be a solution for this. And so we built ourselves a piece of software. We hired an engineer, and we said, all right, this is what we need. Let's start building it for us, and start to automate that process of aggregating all our information, all the emails, the documents, the bank accounts, the cash flow, transactions, like all that. And then a bunch of friends around us wanted it as well. We're like, wait, there might be a whole business here. And spoke with a bunch of people around the world, trying to understand what's out there, how people solve this problem, and found that there isn't a real good solution for them. And so we decided to take what we built for ourselves, raise money for it, and turn it into a whole new business. And that's what Vyzer is, what we're working on today, turned out to be. We founded the company like 2.5 years ago, and it's based on our own problem solving, our own money.
Well, and sometimes I think that there's no better problem to solve than something that you understand intimately. And I know that this is a huge problem, because many of these personal finance managers, if you will, are just laser focused on traditional investments, and they do not serve the alternatives, where Vyzer for me becomes this complete solution, because it's so easy to then plug in whatever brokerage account you may have and just suck that in immediately and understand what that is. But you can also then be putting in individually held real estate. You can be putting in, private equity funds or hedge funds and other things. So it really gives you that full view versus I think pre-Vyzer for me was always, I'm half in a tool and then I'm half in spreadsheets. I mean, it's just frustrating.
Exactly. And yeah, and it grows, right? It doesn't stay static. It's like a dynamic spreadsheet and it grows hopefully over time.
Yeah,
And it
it
just
does.
becomes,
As you have exits and those types of things. And so tracking that stuff, it's important for people to understand again, because I actually think going back to your diamond example, when you walked into the diamond industry and you're like, hey, there's all this high security, then you go behind the doors and it's 50 years in the past. Real estate's really like that too. I mean, I think it's now starting to accelerate with all of the technology that's coming towards it. I think it started arguably with a lot of the property management software, but there's still a lot of great companies that are execute very well from a real estate perspective, but their processes and their systems are really, really outdated.
100%, yeah. And when you invest in these deals, you also get username and passwords to a bunch of these different investor portals, right? And each of them has a different portal, and just like it's just like it's you need to bundle it up again because it's become unbundled, like they say in the startup world, right?
Yeah, no, it really, really has. It's created some sprawl, and I know it's something that um, people really, really struggle with. So, where do you think what do you think the outlook is now for in this high interest rate environment? What's your personal outlook on private equity market?
I think that over the years, the past, I'd say even 10 years, were unbelievable and will not repeat. That's the way I did. What happened was in sort of the abnormal. The normal was when interest rates come back to where they're supposed to be, right?
Right.
Interest rates are not supposed to be 0%. They're supposed to be around 3 or 4 or 5%. And so a lot of operators that came out over the past 10 years will not survive this upcoming period because they're used to easy times. That's the way I see it. Like I think that
Yeah.
the way deals were vetted, the numbers people took into account, the loan to asset values were out of proportion. Refinances, which people think were supposed to happen, won't happen as planned.
Right.
And add on top of that, it's a lot harder to fundraise. It's a lot harder to fundraise now because even though people are still sitting on cash, the alternatives, just for example, the zero risk interest rates, 5%. Like why? It's hard to convince someone that we'll give you 8% annual cash on cash at a higher risk, and people might not want to. So I think the whole play that was around over the past 10 years is going to change. You also see a lot of operators now moving from a single deal model to a
Mhm.
fund model
Yes.
uh, for various reasons, but it's a different type of fundraising and a different type of allocation. And the play now is also there's always going to be good properties to buy. There's always going to be distress. There's always going to be people who need to sell. So
That's
there's
right.
still going to be opportunities, but I only think the best operators are going to survive this upcoming downturn over the next year or two.
So no, yeah, I agree with you. I think as some of these rate locks start to expire and people who, there was a lot of people being very, very aggressive in 21, in 22, just thinking that these tailwinds and you're right in thinking that the tailwinds were going to continue, and then also thinking that rates wouldn't climb as fast as they did. Nobody saw that coming. So as these rate locks start to expire, and I think there is going to be a cycle as, we're starting to see it now as if you've seen some of these Houston deals that have, now gone bankrupt and have been distressed and a lot of investors are losing money. People are going to say, well, wait, I can get five. I mean, I saw on rates the other day, you can get like 5.25 right now in like a high yield savings account. Okay, tell me what that is going to be. And now you're saying I might get 2.5 points more to be in this real estate deal. Like, help me understand that risk. I do think I do align with you in the sense that I think that really robust outfits are going to continue to do well. And we're going to get the opportunity to see the herd being thinned and understand who we want to invest with. So I think that's a good thing. But I definitely think that we're still in for some headwinds ahead, for sure.
Totally. Yep.
Yeah.
Interesting times. Yeah. Interesting times ahead.
Well, I want to thank you so much, man. And as we transition out, we always end up with a little bit of a fire round. I'm going to fire off five questions here. Some skills that sort of help you keep moving forward. So how do you keep learning?
A lot of podcasts, listening to podcasts and educating myself, and also listening and reading books. And that segues maybe into another question, but sort of one of the books that I've valued the most over the last few years that I've read is Never Split the Difference by Chris Voss, about negotiation.
Yeah.
I mean, that's an amazing book. And always surround myself with people that are smarter than me.
Yeah. That's great, because they will always keep challenging you and you're going to be thinking about what was just said in the room. That's a great one. You are founder of a startup. I know you're working really hard across different international hours. What do you do to recharge?
So I have 3 kids, and even though kids don't really help to recharge, I do feel like when I get home before they go to sleep and just enjoy, some time with them before, just like absorb like why we do what we do. Because for me, it's about, the also obviously to build something that brings value to other people, but also because I want to spend time with my family and kids and experience stuff. And so the time with them is sort of like, it fills me up. And also I try to do some mindfulness and meditation stuff. I did the Wim Hof stuff for some time, cold showers and
Yes.
breathing exercises, because there is a lot of stress, right, that you need to relieve it. And so those are the stuff I do. And I try to take some vacations here and there, not a lot, but those are things that sort of fill me up. So like the other week we were on this founders sailing trip, just a bunch of founders going sailing, and it was amazing. It's one of those things I look for like for the entire year. And so,
hey, did they let you drive the boat?
I was one of the skippers.
Oh, you were? Okay, I figured as much. So we've heard about your growth and growing these different companies. What soft skill do you think has helped your career the most?
Creativity and an out of the box approach, I'd say. And I'm super stubborn, so that can help in other. But we're driven to win.
Wow, that's great, man. What has been the best return on your time invested?
This might sound like, again, like I'm repeating myself previously, but I feel like the time I spend with my family is the biggest investment I can put in.
Yeah. It fills you up. It does. It really does. And so what's been the worst money or investing advice you ever received?
So for me, it's like, when we sold the company, people came and said, well, you give us the money and we'll put it in a managed brokerage account, and let's take some loans against that. And part of the money I did and put it at, leverage that at an interest rate that fluctuated now over time. So that was bad advice, to believe that the interest rates would stay low back then.
Leverage.
So over leverage on a,
Yeah. I mean, it's just so interesting when you go through those sudden wealth moments and people come out of the woodwork and they come at you with all this advice. It's really hard to know. It's so hard to know what to do. So that's where I think getting into some of these communities, understanding what other people have done, and this is exactly why this podcast is here. So where can people learn more about you and Vyzer?
You can reach out to me, Litan at Vyzer.co, our website, Vyzer.co, Facebook, Twitter, LinkedIn. I'm super available, happy to chat, happy to answer any questions I can bring value to.
Great. Let's get those links and we'll put those in the show notes. I want to thank you so much for joining us today, Litan, and thank you everybody for listening. This is Tech Careers and Money Talk, and remember, we're a brand new podcast, so please follow us where you listen: Apple, Google, Spotify, you name it, we're there. And we would also ask that you please leave us a review. Let us know what you found valuable in today's podcast. And then please share this with everybody you know. I know there's so many technology employees who want to have this conversation about career and money, and this is the place we're having it. Thank you very much.